Hello everyone, my name is Jainil Shah. I'll be presenting on the first part of our case study, which is on Robert and Fiona Adams. So, this study begins with a successful business journey, years of hard work, smart investment, and careful planning, which have helped them build a significant wealth. Now, as they enter to their retirement, they want to ensure this wealth is protected and passed efficiently to their family. So let me introduce to my team members, which is Stacy, Mark, Jasleen, Kirtiraj, and me. So our goal is to show how smart planning can help them minimize taxes and make the most of their business success. Let's dive in. So let's start with the Adams business journey. Robert and Fiona built Adams Automotive Limited from scratch and just sold it for $2.5 million. They bought their shares for dollar each, which means the entire sale amount is basically a capital gain. This is a major financial milestone, but it comes with a big tax implications. So let's understand their tax impact. Here is the breakdown. So the first 2.5 million sale, which is minus to their $2 cost base, equals a 2.5 million capital gain, but only 50%, so it's 1.25 million, and which is taxable. And since they are a couple, that $6,25,000 is taxable capital gains each unless they take action. So let's talk about the LCGE Lifeline. So luckily they haven't used their lifetime capital gains exemption yet. For 2025, each spouse can settle up to $1 million in gains if the share quality of QSBC is been qualified by Small Business Corporation. That means they could potentially eliminate the full $625,000 for taxable gains. So now let's talk about the spreading the tax burden. So another option is that the capital gains reserve. If the buyers pay overtime, Robert and Fiona can report only 20% of the gain per year for up to 5 years. This strategy smooths out their tax hit and keeps them in a lower tax bracket. Crossing the T's and dotting the I's. So they need to start splitting the proceeds smartly, consider using trust, file the proper forms like T657, and most importantly, document everything about the sale and their QSBC status clearly. Your part forward. So they need to plan according to the 4 steps, which is they need to confirm that their business qualifies as QSBC. They need to claim the LCG for both the spouse. They need to use the capital gains reserve if payments are staggered, and the partner with a tax advisor needs to get the filings right. So the pie chart breakdowns exactly how their sales proceeds and can be protected with the right mix of exemptions and timing strategies. It's not just about reducing tax, it's about securing the financial future. So now Stacey will be continuing after me. Thank you.
Today we're taking a look at Robert and Fiona's financial and real estate assets and giving an opinion on the best strategy for minimizing capital gains and probate taxes and how to best efficiently and tax effectively distribute the wealth to their children. Robert and Fiona have considerable holdings in both real estate and investments, as well as cash from the sale of their business. They have approximately $4.4 million in real estate, 3 properties, 2 of which are eligible for the principal residence exemption, and then $1.1 million in RSPs and $600,000 in non-registered investments, and approximately $2 to $2.5 million in cash, depending on what they have allocated for their charitable donations and their disabled son. Before we look at Robert and Fiona's personal situation, we'll just go over the general tax consequences on death. And I would start with the principal residence exemption, and only 1 property can be designated as the principal residence per family per year. Robert and Fiona have 2 properties that would qualify. They've got their marital home and their vacation property, and one of those would qualify, possibly both, and they could get an exemption from tax on that property. We do need more information on the year of purchase and the purchase price for both properties, and then we would need an accountant to be consulted for how to best use the personal residence exemption for their situation. Generally, on death, all capital property is deemed disposed of right before death at fair market value, unless it's been transferred or willed to a spouse, and capital gains tax may or may not be due. Probate taxes of 1.5% are applicable in both Ontario and BC, and that is to the value of the assets at the time of death. For Robert and Fiona, that could be considerable. The jointly owned properties, the properties solely owned by the deceased spouse, RRSPs, and non-registered investment portfolio can pass to the surviving spouse tax deferred, and when that surviving spouse dies, capital gains are triggered at that point. So vacation property and home, depending on where the PRE is applied, would have tax, and the investment property and the non-registered investment portfolio would both have capital gains tax applied, and that would be at a rate of 50%. The treatment for RRSPs or RIFs on death is that they would automatically roll over tax-free to a spouse or a disabled child, and when the surviving spouse dies, any remaining RSP or RIF is fully taxable as income in the year of death unless it's rolled over to their disabled child. So this could mean significant taxes on death of a survivor spouse because they are added in one lump sum to the income for that year. So Robert and Fiona would be very exposed to that, as they've got about 1.1 million in RRSPs at this point. For Robert and Fiona's situation, we've looked at 2 plans that would be appropriate for them for their assets going forward, and that would be, one would be a joint partner trust, or secondly, holding their assets jointly with the right to survivorship. Essentially, the capital gains treatment are the same for both types of plans. They are deferred or would be deferred until death of the surviving spouse. Under the joint right to survivorship, probate taxes will ultimately be paid at death of the survivor spouse, whilst assets held in the joint partner trust do not pass through probate ever and would not suffer any probate tax. And for Robert and Fiona, that could amount from $75,000 upwards over $100,000, depending on where their assets are at when the surviving spouse passes away. Joint partner trusts are more complex and costly, but they do make administration of the estate easier. So since the assets are held in trust, they don't form part of the estate, and the beneficiaries don't need to wait until the probate process has been completed before the assets can be distributed to them. Also, joint partner trust maintains complete confidentiality. I've done a quick chart to compare the features of the 2 plans, and whilst they're very similar, I believe that the savings in probate taxes and the privacy factor would be very important to Robert and Fiona. So that is the plan that we have decided to go with. The benefits of a joint partner trust for Robert and Fiona would be considerable. It allows them to be beneficiaries, both of them to be beneficiaries during their lifetime. And both Robert and Fiona can contribute the joint assets that they hold, as well as the assets held solely in their names at their adjusted cost base, which would result in the deferral of the capital gains until both Robert and Fiona have died. It avoids the probate fees for the assets in the trust in both Ontario and BC. And as I mentioned, that could be upwards of $100,000 or more. So that is considerable. And the personal residence exemption can also be applied to the marital home or the vacation property, even if it is held in the trust, so that they don't lose that exemption. The trust will allow for centralized control, so they would have complete control over their assets for their lifetime. And as I mentioned before, they would have complete privacy over any of the assets held within that trust because the trust document does not become public. One last point that's also important is if one or both of them become mentally incapacitated, the trust assets continue to be managed by the trustee, so there is no disruption in the management of those assets. Regarding RRSP and RIF planning, Robert and Fiona have approximately 1.1 million in RRSPs, and those may not be transferred into a joint partner trust. The RRSP may not be directly transferred into a Henson Trust either for the benefit of their son. For a Henson Trust, the RRSP would need to be included in their income and taxed, and then the net funds transferred to the trust if they wanted to make use of RRSP funds. So I would recommend that they consider converting the RRSPs to RIFs and start some systematic withdrawals to reduce the value of the RIF over time and spread the tax burden out across many years. And given the amount that they would both be withdrawing, it's not likely to be in the top tax rate. So that would save on taxes. And also for them to be conscious that the goal is to have the lowest possible RRSP or RIF balance at the time of death, because that balance would be included in one lump sum at the time of death. A very important point for the joint partner trust is that only Robert and Fiona may receive income or capital from the trust while they're living. This is a very strict rule. There's no deviation from that rule. So income from the trust that is distributed to them would be at their discretion and taxed at their individual graduated rates. I've looked at the assets that would be income producing assets that would be transferred to the trust, and it would be in the region of 3.8 million, depending on how much of the sale of the business they invest into the trust. And at a 4% yield, that would be the equivalent of about 150,000 of annual income, which would be about 76,000 each per year. Combined with their RIF withdrawals that they're going to make, their income needs to maintain their lifestyle should be met and would also be taxed as efficiently as possible and avoid the trust's top tax rate. Should they need to access any cash in the trust, they can do that as and when they need to, tax-free. Income generated in the trust that is not distributed to Robert and Fiona will be taxed at the trust in the trust at the highest marginal rate. And again, the principal residence exemption on either the house or the vacation property or both is still permitted in the trust, as the trust qualifies as a personal trust. To conclude for Robert and Fiona with respect to their financial assets and their real estate assets, there's a number of items for action on their behalf. They need to review the use of their vacation home to see if it qualifies for principal residence exemption. And they would need to get the information on how long they've been holding both properties and the original cost and their adjusted cost base for both. They need to consult a tax advisor to calculate the best use of the principal residence exemption and the capital gains that they would be looking at. They need to consult a lawyer and an estate planner to confirm that creating a joint partner trust is the right way to go, and it's essential that tax, estate planning, legal advice are obtained before they do anything. They also need to consider converting their RSPs to RIFs and start the strategic drawdowns of those of the RIFs. And then finally, I would just again consult their lawyer or their tax advisor and evaluate whether life insurance is appropriate to offset terminal taxes.
This is the case study for Robert and Fiona Adams as they are doing their estate planning and making considerations for their disabled adult son. Let's take a look at the current situation with their son, Nicholas. He is currently 40 years old. He was diagnosed with a developmental disability at an early age. He has no significant employment skills, and he requires the ongoing support and lives in supported housing. He receives provincial disability, which in Ontario is the Ontario Disability Support Program, often referred to as ODSP. Now, Robert and Fiona have indicated that their planning goal for Nicholas's inheritance is to ensure it provides long-term financial security while also protecting his government assistance and benefits. Now, the first step of this process is to really conduct a needs assessment. And we need to take a look at what are Nicholas's current needs and then predict from that what his future needs will be. So you might think, we're looking at estate planning. Why are we looking at the current needs? To determine how much we need to set aside, we really need to take a look at what is it cost now to sustain Nicholas on a day-to-day and a year-by-year basis. So let's take a look at Nicholas's current situation. As previously stated, he receives ODSP payments, and those would be around $1,368 a month, and that turns out to be an annual $16,416 a year. The ODSP payments primarily covers for him housing and food, and he has likely lived in supported housing for 10 or more years already. And this would be based on his age, and this assumption is going to be important a little bit later on, as I'll explain. It is very likely that Robert and Fiona have supported Nicholas by paying for expenses that are not covered by ODSP. This might be things like transportation, vacations, furniture, clothing, medical expenses that are not covered under the ODSP plan. And so this has probably been an ongoing thing that they've had to take care of along the way. Now that we've taken a look at the needs assessment for Nicholas, we really want to now have the Adams focus on maximizing grants, matching contributions, and tax credits. And the first step would be to apply for the disability tax credit if they've not done so already. The disability tax credit is a non-refundable tax credit, so it will not generate a refund, but it will reduce the taxes down to zero. It is likely that Nicholas at this point does not need to use that tax credit himself, but he can transfer the unused credit to Robert and Fiona. And that is the next step, to transfer that credit over. Since he is diagnosed from a young age, they would be able to apply for the CRA to do a 10-year reassessment, and they'll go back 10 years in the tax returns and make the adjustments, taking into account the tax credit. And then the fourth step would be to open a registered disability savings plan, which we'll talk about more in the next slide. Now, before we talk about the RDSP, I just want to point out something here, the value of the disability tax credit. The disability tax credit would allow a reduction of approximately $1,675 per year on Robert and Fiona's tax returns. And if you were to look at the going back 10 years, they would be entitled to around a $16,750 retroactive refund. Upon opening the RDSP or Registered Disability Savings Plan, there are grants and matching amounts that would be attributed to the plan, and those would be based on Nicholas's income. So because his income is under $20,000, he would be entitled to the maximum amount of matching and the bond payments. that $1,500 per year contribution to the RDSP would result in a $4,500 per year matching amount and bond. These contributions may continue for 10 years from his age of 40 to 49, and they can also go back and make up 10 years of missed contributions. Now, if we take the amount of the disability tax credit of $33,500 that they would receive on an annualized basis going forward for the 10 years, and we were to take the retroactive payments for the last 10 years, and they took that amount of money and they reinvested it into an RDSP, that would attract around $90,000 in grants and bonds. Assuming an annual rate of return of 6%, Nicholas would have over $400,000 in his RDSP at age 16. The advantage of the RDSP is that when the withdrawals come out of the RDSP, they do not impact his entitlement to the ODSP payments, and later on, they won't impact other means-tested benefits, such as old age security and GIS. The final stage of their plan for Nicholas is by creating a Henson Trust. And the common and simple methods of inheritance, including direct inheritance and joint ownership with right of survivorship, and that could pertain to real estate or investments, they would adversely affect Nicholas's benefits, such as ODSP. That income would then put him over the threshold, and there would start to be a clawback of those benefits or a complete elimination. The Henson Trust preserves Nicholas's access to disability benefits such as ODSP, and the Henson Trust is commonly used in conjunction with a retirement disability savings plan. Let's take a look at the key components of a special needs plan. The Henson Trust itself is drafted into the will. The next thing is to choose the right trustee, and there's really two trustees we're looking at here. We're looking at the trustee of the will, and we're looking at the trustee that will eventually be appointed with the Henson's Trust as well. You want to choose someone that is trustworthy and is willing to take on the work to ensure that Nicholas is supported financially once his parents have passed away. A thing to consider is a letter of intent. A letter of intent is not a legal document, but it is a document that can inform the trustee of how you would like to see the money used, and it really helps the trustee stay focused on the wishes of the parents that have put together the Henson Trust. Considering guardianship, at this point, it might be wise for them to start maybe even transferring guardianship from themselves to maybe Nicholas's sister, and that could be now or it could be in the future. Again, you want someone that really knows the person and is willing to take on that role and look after their best interests. And you want to make sure you've aligned the beneficiary designations from other funds, because the Henson Trust does need to be funded at the time that it is set up. So you need to think about where are the funds going to come from that go into the Henson's Trust. So some key takeaways from this part of the presentation. Providing for adult disabled children are a unique situation, and it does require careful planning within estate planning. Poor execution of this can lead to a loss of benefits or disability supports for the disabled person. Appointing the right trustee and guardian is of utmost importance, and it is advisable to seek out legal advice with a firm with estate that is familiar with estate planning for special needs dependents. And here are a variety of sources that were used as reference in creating this presentation.
Now let's talk about the education planning strategies for Robert and Fiona's grandchildren. Although the primary goal is to support their grandchildren's post-secondary education, Robert and Fiona must also consider long-term control, tax efficiency, and how these plans integrate with their broader estate. With no RESP account currently in place and only 7,000 saved by their daughters, there is still time to maximize their government education grant, particularly if the action is taken immediately. We will discuss some recommended strategies which will be quite helpful. RESP is considered as the primary focus, as RESP means Registered Education Saving Plan, which is made for children specifically. As grandparents, Robert and Fiona can open a family RESP and act as a subscriber, giving them full control of contribution and withdrawal. This is the most effective and grant eligible vehicle for post-secondary savings. There are a few strategies related to this, like opening a family RESP for both the grandchildrens and contributing 5,000 per year per child to catch up on unused Canadian education saving grant room. In case of 10-year-old child, they can receive the full CESG lifetime grant of 7,200. But on the other hand, for the 12-year-old child, only 6 contribution years remain before the age of 17, allowing for a maximum CESG of 6,000. And it's quite optional to make a one-time top-up to reach the 50,000 lifetime contribution limit per child. There are few estate planning notes which are quite helpful. Like if Robert or Fiona pass away and are the sole subscriber, the RESP could collapse unless a will exists with an appointed executor and the will includes an RESP clause. This allows the RESP to continue or a replacement subscriber to be appointed, protecting their grant and investment. Without this, the RESP would become part of the estate and all the government grant would need to be repaid. There are few pros and cons related to RESP. First one is CESG provides 20% match on first 2,500 per year per child, and the fund grows tax deferred, which is quite a great deal. On the other hand, the withdrawal taxed in the child's typically lower income bracket, and the assets can be transferred between siblings if one doesn't pursue education. On the other hand, there are some cons as well, like the fund must be used for education related expense only, and the CESG is only available until the end of the calendar year in which the child turns 17. The over contribution are penalized at 1% per month. There are few supplementary options as well. The first one is TFSA, which means tax-free saving account. It is quite flexible and tax-free supplement. Robert and Fiona can also use their own TFSAs to save additional funds for education, especially after RESP limits are met. There are a few strategies, like you have to contribute regularly to their own TFSA account. Earmark these funds for future education support. Name their grandchildren as TFSA beneficiaries in their will or account documentation to ensure the funds transfer tax-free upon their death. And the TFSA also has some merits and demerits. Like the first merit is tax-free growth and withdrawals, which is quite beneficial, and no age or usage restrictions are there, and it helps to reduce the estate value, which avoids the probate fees. Moreover, it has some demerits as well, like no government education grant is provided in this, and the gift must be managed carefully to ensure they are used for education purpose only. The interest account is the second supplementary option for additional flexibility. Like informal trust account can also be created to invest money in the grandchild's name, especially if the RESP and TFSA's limits are maxed. There are few strategies related to this, like you have to contribute funds to informal interest investment account, focusing on capital gain based assets to minimize attribution. It also has some pros and cons, like there is no contribution limit in case of informal trust, and it can be used for broader purposes like housing, traveling, or education as well. Moreover, it has some cons as well, like income, trust, and dividend may be taxed in contributory's hand, and the funds legally belong to the child at the age of majority, and they have limited control before that, and no government grants are provided in this case. Now we will discuss about the hybrid recommendation. So this slide outlines the core steps Robert and Fiona should take to build a comprehensive education funding plan for their grandchildren. First of all, we recommend they maximize RESP contribution right away to catch up on unused CESG room. This government grant provides a 20% match, so the earlier they contribute, the more they gain. The second one is a lump sum top up can help them to reach the RESP 50,000 lifetime limit per child if they have the funds available. And the third point is to protect those RESP contributions and grant in case of death. It's important they include an RESP clause in their will and appoint an executor. This ensures the RESP doesn't collapse and lose its grant. The fourth option is we recommend they use their TFSA for additional savings, but with a twist, like they should add the names of the grandchildren as beneficiary to allow for a tax-free transfer of funds if something happens. And the last point is if they want to go beyond RESP and TFSA limits, they could set up interest accounts for each child, though these come with less control and some tax implications. So in the summary, the hybrid strategy which we have discussed offers the best of all worlds. Like the RESP gives them access to government grants and tax deferred growth. With proper estate planning, which includes a will, executor, and RESP clause, they can make sure those funds stay intact and benefits the grandchild. Moreover, the TFSA offers added flexibility and tax-free withdrawals, and by naming their grandchildren as beneficiary, they avoid probate and additional taxes. The interest account can act as a final layer of support, especially if the grandchildren need help with non-education related expenses, but they should be used with care. Overall, this layer uh, plan allows Robert and Fiona to meet their financial goals and support their family education and do it all in a way that's smart for both a tax and a state perspective. There are few references as well, which I have tapped with the PPT, which can be more helpful to understand the concept. And my colleague will continue the rest of the PPT.
So good evening everyone. Today I'll be going through the estate planning philanthropy plan designed for Robert and Fiona Adams. They are both recently retired in their late 60s and had a successful business career. After selling their business, they are now focusing on how to use their wealth meaningfully. They have three main goals. First, they want to minimize taxes. Second, they want to make sure their disabled son Nicholas is financially supported for life. Third, they want to help fund their grandkids' education. And finally, they like to leave a lasting legacy by donating to the UHN Hospital Fund. Philanthropy objectives. Their goal around philanthropy are pretty clear. They want to make a real impact in the healthcare through UHN. At the same time, they don't want this donation to affect other priorities like family support. So we are aiming for a strategy that provides flexibility and reduces their overall tax burden while still achieving that charitable impact. Donation options summary. We have suggested two strong donation methods. First is donating appreciated securities during their lifetime. This avoids capital gains tax and offer tax credits up to 75% of net income. It also means UHN can benefit immediately. Second is setting up a donor advice fund, which is optional but powerful. It let them spread their giving over time and still receive an immediate tax credit when they fund their account. It also gives them flexibility to adjust donations in the future. So This plan checks all the boxes. It personalized for their situation, balancing their desire to give back with the need to support the family. It lowers the estate's tax burden and allows them to leave a bigger impact through strategic giving. And structuring the philanthropy here, how it would work in real life. While they are alive, they donate securities and maybe open a donor advice fund after they pass away. This is the part of their RRIF can go straight to UHN. This avoids probate and offset taxes on their final return. They can also include UHN in their will, giving them flexibility in case family needs change. And the closing strategy map would be in like this approach supports healthcare in a meaningful way and still ensure Nicholas and grandkids are well looked after. It's a win-win, tax wise, impact wise, and legacy wise. So these are some references. And closing summary, this estate plan for Robert and Fiona isn't just about reducing taxes, it's about making sure Nicholas is financially secure, their grandkids get the education they deserve, and lasting impact is made through healthcare support. The strategy uses a mix of joint partner trusts, RRIF conversion, RESPs, pension trust, and philanthropy, each one fitting together like a puzzle to meet their unique goals. So thank you so much. That's all from my side.